why is ESG everywhere now? Why should we care? Is it a bunch of policy wonks making our lives difficult? Give us the 3-minute overview for why it's everywhere and why we should care.
Good morning, everyone. Delighted to be here. 3 minutes. So I hope everyone here knows what ESG is, but really briefly, environmental, social, governance factors starting to get integrated into investment decisions. And the answer is, it's complicated. There are a lot of factors driving ESG interest. So let me run through them. The first is a major shift how investors think about ESG from ethics. Many of you, when you hear ESG, you think, oh, those were those days when you didn't invest in Sudan or didn't invest in guns. A shift from ethics to material investment decisions. That shift has made it a much bigger tent, a tent where every investor is now thinking about it. On top of that shift, you have regulatory changes. So different governments saying, I'm mandating companies to disclose different data and actually investors to start to consider ESG considerations. And then the third element is actually clients and end consumers being more interested in sustainable issues. So our clients are demanding, my institutional large pension fund clients are demanding that we consider ESG. So on top of those three factors, sitting in the background, I think is a really interesting group many of you may have heard of called the Principles for Responsible Investing. And why that's interesting is that organization works with large investors to say, are you committed to integrating ESG into your investment decisions? And over the past decade, many, essentially all of the major large investors have signed up into that commitment, but they haven't acted yet. So they've signed up in principle, the concept, and it's about a 3 to 5 year wave before you sign up to something, and you have to sign up at the highest level of your organization. Your CEO has to say, I'm going to start considering ESG, and now it's finally getting to the phase where people are starting to integrate it into how they make decisions. So that's the kind of backdrop, and that's what's, I think, bringing it to the fore today.
Sarah, I'll disappoint you in that I may not be able to contradict John. I happen to agree with everything he said, but I may be able to add a point or two of emphasis. And before I do, I would also like to say thank you to Amy, to Sarah, to Jen Cox as well. It's a wonderful event, and NACD should be very proud of the representation in this room. I work with the Minneapolis chapter. I used to be a member of the Seattle chapter in my former life. This is great. You have a lot of, this signals to us anyway, that in this city there's a dedication to board practices and to proper governance. So thank you all for being here. Hopefully we'll not let you down. To continue on John's point, I would add one more to his list of 3, that as data improve in this space, the data continue to tell investors like us that your firms and other firms' ESG performance is an investable signal. And what that comes back to is a topic John touched on that I think is worth dwelling on for just a moment. An analogy I use for a couple of you that I've met with in this room, forgive me for repeating myself, but we will often in our engagement meetings or in our research work with portfolio companies, hear companies come to us to say, look at these great things that we're doing that are ESG. And we'll hear things that are interesting, but are not financially material. We'll hear about how many community playgrounds were refurbished, how many light bulbs were recycled. And I'm not, by the way, intending to put those activities down. There are some stakeholders of yours to whom those things are important. But for investors, they're going to be interested in those things that could potentially be financially material. You stop and think about E, S, and G factors, you will not find them, I will not find them anyway, I have yet to, on your financial statements. Your environmental policy, your human capital. There's no line item for those things. They're embedded, but these are factors that are really sort of external, if you will, extra financial factors that will come to bear under certain circumstances on your financials. So for us, as we look to you to help us better understand your performance on E, S, and G factors, we encourage the focus on a narrow set of those things that are most potentially financially material. And we'll, I think, talk a bit about what some ways are to do that. And for us, then, that becomes a way to better assess performance. It's additive to our fundamental investment view of a company and helps us to better understand factors that may come to bear on your financial performance for the long run. So that data becomes very critical. And so as the data improve from a disclosure standpoint, I think today 86% of S&P 500 companies are producing a CSR report. We're ingesting that information. We can make better investment decisions. And I'll cut to the chase for anybody that might be skeptical. Academic and practitioner research shows that ESG investing in its various forms can be additive to investment performance. It's not necessarily a detractor. So I'll just cut right to that.
So back to you, John, if you could just flesh out, so you got a C+ on the essay question so far, so I'm going to give you a chance to get it up to a B+.
Tough grader, isn't it?
Yeah. So to what extent are ESG issues focused exclusively on voting? And if not on voting, what are the other buckets in which ESG is now creeping?
Sure. So I think a helpful framework to look at how does ESG seep into investment decision making is to break it into 3 distinct buckets. So the first bucket is what we call ESG integration. So that means using ESG data to influence a buy-sell decision, to influence fundamental analysis, looking at how competitive you are relative to your peers, to influence your valuation on a particular company. That's one style of ESG analysis. A second approach is what we call stewardship. And so that's when ESG factors come into proxy voting strategies, into engagement strategies. So as a large investor working with many of your companies, when we want to understand your environmental disclosure, it was being perhaps signaled by a poor E-score from one of these data vendors or our own analysis that's saying it's not going so well. And actually the third bucket of where ESG comes into investments is actually solutions and funds themselves. So you may have heard of sustainability tilted strategies, low carbon tilted strategies. So that's actually a whole different way structurally that ESG is making its way into our analysis. So sometimes it changes investment decisions. Sometimes it changes how you own a company, how you work with a company, and lastly, how you actually design the product itself.
And Mac, is this exclusively in the equity world?
No, great question. And I think that's a misconception, is that any of the factors that we're talking about here for us investors only apply to how we think about stocks. And the reality is, not only today does it apply to corporate credit, so investment grade or high yield bonds. It's part of our work and my team's work. This is now actually bleeding across every single asset class. Just as a mundane example, we have a large bank loan business that sits alongside kind of between our investment grade and high yield business. And we've integrated ESG into our bank loan business. Commodities. We have in Europe money market funds that operate a little differently than they do here in the US. We've embedded ESG in that. This is the direction of travel. We haven't necessarily touched on Europe. I'm sure we'll get to the influence of Europe. Many of you may have European investors. That's where a lot of this begins. But it is clear the expectation is that this is not isolated thinking. This is just not, to John's point, about how these extra financial factors might bear on an equity or stock investment buy-sell decision. I believe in 10 years this will be fully embedded across all asset classes, everything that firms like ours manage.
Let me add one. So Legal & General has a very large U.S. high-grade credit team that sits down the hall from me. And over the past 24 months, they have moved from an informal ESG analysis where they're taking data from different third parties to now a very formalized process where we have a central house view of the ESG profile of every company, every public company in this room. We have a house view of your ESG profile. That data is getting sitting exactly next to your financial analysis of your position. When they think about investing in high-grade debt, they're actually building this right into their fundamental assessments, and it changes their view of probability of default.
Maria Dunn, are you sitting here in the audience somewhere? Ah, there you are. Would you by any chance be involved in any committee that would be working with banks on how ESG is integrated? Would you? It's good. You know the difference between a yes/no question and an essay question. Good start. Could you give us the 3-sentence summary of who the counterparties are and what is the organization you're working with? Fabulous. Thank you. And sorry, I didn't warn you I was going to call on you, but I see some other victims in the audience, so this could potentially be fun. All right, let's move to some slightly more rapid-fire questions. We were talking last night at dinner about how there's been an evolution in the weapons that shareholders use interacting with issuers over ESG issues, and that it started in the actually 1930s, but it started more robustly in the 1980s with the use of shareholder proposals, which of course are largely precatory and largely limited in the subjects on which they can be filed. Steadily moved to executive comp, which has a little more oomph to it, especially now that it's automatically on ballots, and has recently moved to a much greater focus on the vote for and against directors, which of course is the power vote. So I'm hoping that each of you can talk about how you are using the director vote today, what causes you to vote for and against, what issues or what individual things, and then particularly where you see this being in 5 years.
I'll go first. The director vote is a critical vote, and for the reasons that Sarah indicated, it's a binding vote, unlike many other things that come before us to consider. And frankly, it's the most important vote. Our firm will cast hundreds of thousands of votes in the course of a year, and half of those are on directors. They're binding. It matters who we put around the boardroom table. And I can give you a grocery list of the things that we'll look at, but in terms of the basic approach, we approach this as we want to vote for. We want to vote for. There are things, however, that would cause us to withhold our support, and some of them are mundane and logistical. It's overcommitted directors, it's attendance, there are a host of other things. Independence is an obvious one in the United States and is cared for in other ways. Other markets, whole different matter. We can discuss Thailand if you want at any time at length. However, governance issues, broadly defined, become a critical point, and performance becomes a critical point, where it's clearly more subjective. Any rational, responsible investor is not going to just say, oh, we're going to vote for or vote against solely on this basis. It requires considerable work. So for us, thinking about what some might deem to be sort of a more subjective vote requires considerable analysis, and it happens in the context of our fundamental research process and in tandem with our portfolio manager. So it's a firm decision, not just a policy geek, proxy geek like myself or others with a checklist. It does require considerable thought. Thankfully, that's not frequent, but these are factors that come into play and are considerable. And what we do with those votes, I think we're going to get to in a moment. I would add, in Sarah's nudging in our conversation last night, I do believe the direction of travel is, over time, fundamental investment managers like ourselves are going to be more involved in directors. And what I mean by that is not just how we exercise votes, but who actually comes to the fore in nomination processes. I believe that that is going to be the direction of travel for active managers like our firm and others. Some of this work now happens today already behind the scenes. I believe there will be in the future more public instances of this happening.
Just want to emphasize, in case you were napping for a minute, Mac was just saying that the large shareholders are likely to be more involved in selecting you. In case you missed that, just going to emphasize. Do you have a blacklist, by the way?
Is the tape recorder running?
That's a yes. That's a yes. He has a blacklist. I think most of the big institutions that I talk to, even if it's only privately, indicate that they do have lists of individuals whose failings or whatever on other boards means that at least the starting proposition is withhold the vote from them absent evidence to the contrary.
fair way of describing it. We may not start with the 4 vote on those.
Yes, you would not start with a 4 vote on those. I have heard from a number of energy PMs that every director on Anadarko's last board is on a blacklist because of the exit packages. So, John.
So from a legal and general perspective, we have a slightly different starting point. Our investment thesis tends to be ultra long-term, really on the equity front, usually coming from this index mentality. You're going to be owning this company forever. And there are absolutely scenarios where there are structural issues that we think are important to all of society that will actually come down all the way to your company and then get expressed at a director level. So what does that mean? For example, on diversity at a corporate level, we think this is an incredibly important issue. We are in the press with very publicly saying we expect public boards to have 30%. And what does that mean from a director vote? That means if you're the head of Nom and Gov and you aren't at 30%, it'll be in 2022, there will be a vote against the head of Nom and Gov. Where it becomes, and so again, it's not subjective in the sense, maybe the 30% threshold is subjective, but the process is very much a principle-based process, which matches very much with our index mentality. Where I do think it becomes not subjective, but it becomes let's say, much more difficult in the market. And I know I'm in Houston, but I want to be really transparent of how we think about this. Climate risk is a huge issue for legal in general. And we've thought about how do you express that? What's the strategy? And about 3 years ago, we rolled out something called the Climate Impact Pledge. And it was our focus on driving disclosure, not performance, but really disclosure around climate risk. And we went all the way so far as we created a proprietary rating, working on a whole host of issues related to governance, to risk management, to disclosure and metrics and transparency. And if we don't see proper disclosure over a period of time after engagement, it actually triggers a vote against the chairman of the board. So it's just an example of being more aggressive, linking strategy issues all the way to board director.
And you just might vote against CEOs on boards if there's not a split chair CEO?
Yeah, that's we will hotly debated topic last night, but we do.
That's why I brought it up.
We do, in general, taking a step back. We've long held very strong views on independence of board, and that manifests itself in our tenure positions over boarding positions, and increasingly on whether it's appropriate to have a combined chairman and CEO. And so we are shifting our policy to push that even faster.
Sarah, if I might just add one thing, because we touched on this last night in our conversation, didn't really explore it. At our firm, thinking about directors and just sort of thinking about boards broadly, we bucket into sort of 3 different elements. People, which we've sort of addressed here, the individuals who are going to be seated around the board table, skills, experience. We're looking for cognitive diversity in its many forms. That's how it brings to bear. We're looking at board process, and we're looking at board structure. So people, process, structure. And that the totality of that is really what ultimately will drive many of our votes and things that we're talking about. But the challenge we have, I think you can all appreciate, is that we might put the right people around the board table. The board has the right processes and structures, but we don't know what happens when the boardroom doors close, right? And I think we've all seen people who are accomplished, they have bright ideas, the boardroom doors close, and you have dynamics issues. That's not the kind of thing we can easily solve for. So I'm sort of interested where we all go collectively, having a better understanding of boardroom dynamics. This is where we talked a bit about last night, the director assessment process and evaluation process. But for us, a critical sort of avenue into board dynamics comes through the lead independent director or the independent chair. And to have an understanding of what in fact are the dynamics like, are they constructive, et cetera. That becomes an important data point.
So I'm going to push you in answering the question I asked, which is the specific issues that will prompt votes against withheld support for directors now and in the future. So you mentioned a couple, lack of diversity, climate concerns, a governance failure, a structural failure, like not a split chair CEO. There are certainly shareholders who will vote against directors for other governance structure failures, like no shareholder ability to vote on the bylaws, no ability to vote a sunset on a poison pill. I have heard some talk of shareholders voting against directors at company B if they don't like a dual class at company A. And I'm curious if there are any other specific issues for this group to be watching for, either that you're considering now or over the next 5 years might prompt a director vote.
I think you've categorically hit many of them that, at least for us, are under consideration. I think if an issue at point A, vote differently at point B is one that we're increasingly focused on. So if effectively think of the knock-on effect of an individual director, the concern we have, again, without the insight into the boardroom dynamic, what the contributions are, we have to, under certain circumstances, assume that that director may not be performing adequately at company B. I would point out, we haven't discussed this, but voting is effectively binary, right? It's for or against. We've evolved in part because of sort of adopting a bit of a European view, and we're using this in the United States now. We're treating this more like a semaphore. It's red, yellow, green. It's not just red and green. And so we're using the abstention vote differently today than we have in the past. And it's a way to send, in our view, a signal that says we have a degree of dissatisfaction. Now, we recognize in some states that has interplay with vote tallies. We understand that. But for us, what becomes important is what it is we're attempting to signal, not what state law is that's governing that particular company and vote tallies. So there are instances where we will, having observed a practice or something that is of concern to us, we will typically, not always, but typically abstain first, year one. And if after engagement we aren't satisfied with progress, year two could result in a vote against. And we think that that's, today, an appropriate way to signal dissatisfaction without creating massive issues. That's not always properly understood. Some of that is on us to better understand and explain to portfolio companies our voting and why. I think for a lot of you, you probably wonder, Sarah, I know you want to talk about this today, well, why did investor X vote the way they did? There isn't a lot of transparency into that, and I think the market ahead will begin to solve for that.
One of the questions we got on this question was, if a board member or a CEO is asked to leave for a personal scandal reason, a Me Too reason, will that prompt a no vote at the other boards on which that person was serving?
Interesting. So I'm going to be very candid, is we absolutely would not have a policy for that. But it's, I don't know. So the answer is no. It wouldn't instantly do that. I think that would probably be the intention over time, but we haven't codified that. A lot of our director-based votes are going to be policy-driven. So slightly different than Mac. I try to think these are as transparent as possible. I mean, my hope is that teams are never surprised, right? So when we engage in off-season proxy or off-season engagements, and people want to have an understanding really specifically about why we voted against a director, we try to be incredibly transparent. We don't want any surprises, but we have not codified that particular one. But I think that's probably a reasonable. That's probably reasonable. But how you codify that in a way that's clean enough, I mean, that's really hard.
Facts and circumstances.
Facts and circumstances. Another question related to how you use the director vote that influences its power, which is obviously already substantial. For many, many years, most institutional investors would be shocked if you asked whether they would ever disclose in advance of the annual meeting how they would vote. And yet in the last few years, there's been a slight increased willingness of some institutional investors to pre-announce all of their votes. It has proven to be very powerful. When Norges Bank did it a number of years ago for some overboarded directors, most of them were gone before the annual meeting even took place. And just recently, Norges has announced that it is now going to pre-announce all of its votes for all directors. And I know Legal in General has done that in some targeted cases. I'm wondering, going forward, Mac, are you there yet? And John,
No.
are you expecting to move beyond the targeted pre-announcing of director votes?
You know, we've done it situationally. Unilever was an instance just earlier this year, Amsterdam-based consumer products company, where we just could not agree at all fundamentally with the decision they were imminently going to be making, and so we not only signaled our vote in advance, we made it noisy. We went to the press and the City of London and made it very clear. We've seen other instances, but for us, it's a situation we don't have the policy yet.
And I'd echo that with a few exceptions, which is, so we were also part of the Unilever pre-announcement, and it was successful. For us, it's not a matter of, it's frankly a matter operationally. So right now our policy is we don't pre-announce unless it's contentious and we think it's strategic for long-term market value. But it isn't a matter of the principle we don't want to. It's actually, there's some operational limitation. So I would suspect that over time, both us and many other asset managers, I mean, the whole, as you guys know, the proxy voting process is cumbersome and operationally hard. So I think as that barrier starts reducing, I could see us go there, but today I can't commit that's something where we are, but I don't think, we're not against that as a signal to the market mechanism.
I think it's worth just a 10-second education for everybody here in case you're not aware. The proxy voting process today in terms of announcing the vote in the United States is archaic to the point where this only applies to mutual funds, but under SEC regs, the mutual fund complexes have a window in time in which they indicate what the votes were for not just the prior 12, let's say it's a 12-month defined period, but it effectively means you can go 18 months between when a vote was actually cast and the vote itself becomes public. And I think many of you know that if you subscribe to the services that like to roll up that proxy voting data on what your investors were saying and doing, but that is not an adequate mechanism for the marketplace to have that kind of timing. So that's where your question really comes from.
And I'll add one concept on that, which is from a legal and general perspective, where we take a lot of care in our proxy voting strategy. Part of our mission is to make it as transparent as possible. So way faster than what's required through different, forced disclosures. We're going to be posting that on our website transparently within a month is our general goal. So it just gives you a sense of, and that's where we're trying to compete, actually, trying to say we're so transparent about this, we care so much that we're going to make it available before the market requires.
So just back up briefly, because it's one of the questions we got. Do you vote against directors on term limit bases? It's obviously more common in the UK, less so in the US.
Sure. From a legal and general policy point of view, after 15 years, we view directors as no longer independent. That means, I think, it's 9 years legally in the UK, but in the US, 15 years you're no longer independent. It doesn't trigger an instant vote against, but if you're chairing a key committee, then it would be a vote against.
When I was corporate secretary of the firm where I served, we had a director on the board for 42 years.
Impressive.
And he was our best director, hands down. So granted, that's a small data set. But my position is that age or tenure per se for an individual director should not be by itself a determining factor. Where we have a problem is and we see this more frequently than I wish we did, where a company says mandatory director retirement at fill in the blank, 72, 75, and you have somebody that's 77 still sitting on the board. Why? Well, we like Bob, we like Sally. That doesn't work. And that needs to be better messaged and better handled. I told the story last night at dinner of a company, and mind you, this is in India, 78 years, one director. And by the way, that's not the director's age. That was their tenure on the board. So that company's name is now a verb in our organization when somebody's been on too long. I won't go there with names. That's an extreme example. We did happen to vote against in that particular
Just
instance
happened
when
to
we
vote
discovered
against.
that. It's like, all right, maybe he's been around a little too long. He was a founder and he was in his 90s and had terrible attendance record, et cetera. So I think we have to be careful and thoughtful about that one because this is where the balance on the board and skills and experience become so critical. And just because, my view, our firm's view is if somebody has 21 years on the board, is it adequate to, by itself, move them on? There are some countries around the world. Spain, for instance, has effectively a hard figure. If you've served beyond 12 years, you're deemed, from a regulatory standpoint, no longer independent. That's really where a lot of this thinking is coming from. In my mind, a better gauge of that is what's the average tenure on the board.
I should defend myself once
on
this one. So why? So I just want, in case it's not crystal clear, for why do we do that 15 years? Like, does that seem unfair? And I completely agree with Mac that there are going to be situations where you have an excellent director who's been there for too long, right? So from our mentality, we have 20,000 public securities, and how do you think about the philosophy of board refreshment? What's a simple way? And many different directors are going to get caught up in this. Long-serving director. So for us, we just don't have the analysis that can go case by case and say that was a great director. We wanted to flip it. So it is definitely you could call it lazy, but it's more of a principle that hopefully increases the bar across the board.
So 2 practice points from that. If you have a long-serving director, for crying out loud, explain it, because John and Mac are voting a whole lot. And then a lot of these issues that sometimes trigger withhold votes obviously become much more toxic in activist situations. So even if they're not automatic, long-tenured directors are great fodder for activists. Mac touched on briefly, so we'll glide over it, the fact that the last step on this train of actions that shareholders take is the selection of directors. I would just flag for you that the Canadian Sovereign Wealth Fund, CPP, now relatively regularly selects director candidates, including their own people, and puts them on boards. It obviously happens in some European countries, so just flag that as a trend. But let's move quickly in the last sub-point on this director section. This year, we saw for the first time a Just Vote No campaign that worked. A shareholder who didn't run a slate of directors to replace the current directors, but who ran a campaign simply to unseat the current directors, which of course in general is much cheaper than a proxy fight, and in general it's probably easier to get agreement over who you don't like than it is to get agreement about who you like instead. And I'm curious how each of you think about Just Vote No campaigns, any possibility either of you would start one?
It hasn't been a major focus for us, and we would not, I do not see us, again, thinking of this from a passive or an index approach, that would, for us, that'd be very much viewed as kind of an active decision. So for that particular one, that's not an area where we are going on.
So I love this. My favorite answer is facts and circumstances. But
it's so wimpy of you.
Well, I will tell you, we see, of course, several of these. I'm surprised that the one Vote No campaign that was successful hasn't really received much press. It perhaps should have. I think it's a somewhat big deal for all of us collectively, and I do believe we will see situationally more of these. So for us, who is the proponent of that action and what are their aims becomes the critical matter. We see, if I may just sort of hypothesize here, but you see the trade union that targets a particular director or group of directors. In my experience, often sort of digging down, the issues at hand tend to be around, they tend to be workforce issues, fairness issues, et cetera. It may be pay related, it's sort of a precursor to a strike, sort of a host of things. So none of that really makes it clear from a policy standpoint to say we would always support that. Your question, I think we shouldn't bypass either, is would we ever undertake one of our own? I think probably only in an extreme circumstance. But that you're talking about doing this publicly, right?
Right.
Having that kind of action taken behind the scenes would not necessarily be uncommon in today's marketplace.
And in effect, a pre-announcing of a vote is a quasi Just Vote No campaign.
Correct.
And may start to work. Let's move quickly to a few questions about how to engage with these guys. As you know, it's become gospel in the issuer community, probably fueled by people in the advisory community, so apologies for some of the sourcing, that you were supposed to call them every fall, which is called the off-season, despite the fact that everyone calls it the off-season and tries to call in the fall, which strikes me as the on-season, and have a conversation with them whether they need it or not, even though they have 20,000 holdings and you have nothing new to say that isn't publicly out there. Not surprisingly, a lot of issuers are having trouble having that work, and we constantly get clients saying, well, I wrote to our top 50 shareholders like I'm supposed to in the fall. I say, so what was your uptake? Well, about 3. I said, do you think that means it's working? And yet they repeat what is not working over and over again. So I would love to have each of your views on how issuers can best engage with you when there are no problems, because it's too late to meet you when there are problems. And I will throw out some examples that currently exist, but you can also create new ones. There are now issuers who invite a shareholder to every board dinner and ask them to give a presentation. There are group events, either a group of companies inviting shareholders or shareholders inviting a group of companies. There have been companies that have formed shareholder advisory committees so they get to know a small group better. There are now some situations, even in the US, I know it's common in Europe, where directors have gone on engagement meetings unchaperoned by anyone in management. There are new efforts to reform investor days so that directors are there, so that ESG issues are covered. There are mixed meetings where analysts and voters attend together, and then various unusual ways to reach out to directors directly. So how should the directors in this audience avoid annoying you and make sure that they know you before it's important to know you?
Sure, I can start on that. So let's start with the simple process, which is this blue sky off, and then we'll go into the kind of these newer forms. So the blue sky engagement, off season, really the purpose for us, the purpose of those engagements should zero in on where we have differences of the areas that are these emerging areas where we may have differences of point of view and we want to trade them. It shouldn't be used to understand things that are factually known. So I mentioned we try to be incredibly transparent with our proxy positions. It's all shrouded in guidelines. So of course, going into that call, hopefully a director's on the phone, but the director and the head of IR should be really aware of what our principles are. And so we shouldn't be debating our principles, right? So that 10-year question, is it 15 years or not? You're never gonna, that's not valuable. What's really interesting are those new emerging issues. It's a brand new shareholder proposal. It's never been there before. Let's zero in on what's the real nuance that's important. Or if it's compensation, don't ask the principle-based compensation questions. Maybe there's an interpretation of how you value options and we have two different sides, and now we have a really clear understanding of the two perspectives. So for us, the purpose is to zero in on those interpretive elements that are right on the edge. Having a director is really, really valuable. We see it as a signal of how important engagement is. Of course, the basics of having prep material, but really just knowing who we are from principles is the key one. From Sarah's question about the emerging new items that I see, it is fairly new in the US, but we are getting invited to come to boards to share our point of view. And what I think that's really about is I think the IR person has an incredible amount of power when they go back to the board and say, here's what we learned. And I think boards are increasingly interested in, we want to hear it directly. You don't want to do it often, but you could be once a year, and try to change up who that is. Bring in some of your biggest ones, bring in some of the kind of ones that think differently. But now, all 10 directors sitting around the table are going to hear it. And I think that is, with the right structure up front, for what I've seen so far is, and I've only done a handful of those, it's a much newer phenomenon. I think the boards find that very valuable.
I would encourage companies and directors to think about, if not compel, the extension of your current IR strategy or an enhancement of your IR strategy to this realm, which means targeting your investors with an understanding of what their aims are, as John said. You have investors that may be value focused, they may be growth focused. That's going to bring sort of a different frame of mind to their conversation and what their questions are. So just sort of one point would be approach using, I think, some of the examples you gave, Sarah, there were one or two there that I wasn't familiar with, but many I am. And I think firms are getting more, if you will, sort of creative, not for the purpose of getting investors' attention, but just to have that proper engagement point so you can have the kind of dialogue that's fruitful and not just a check the box. We're starting to move beyond the check the box. We still have a number of companies that just, well, you know, the board told me I got to reach out to you, so here I am. We get a lot of those kind of conversations. John makes an important point, I think hopefully is not lost on the audience here today, is that the involvement of directors becomes really quite crucial, in maybe not in all engagements. There are some that are going to be somewhat routine or mundane, but for investors to hear from the board the philosophy, the focus, becomes a critical way. You avoid sort of the distillation that naturally happens when messages are communicated back through management. That happens. But to have a director there becomes a valuable conduit. It's a relationship building opportunity, no doubt. But that free exchange of ideas, in my experience, is by far the most fruitful opportunity we can ever have. So we accept those opportunities. I would tell you that of the engagement inquiries we get, just a couple of stats, I accept 1 out of 9. Okay, so put that in perspective. We own 6,500 companies equity-wise in our portfolios. So these are some massive numbers. And many of those we know are sort of the check the box. We're now increasingly reaching out, so proactive on our part engagement. That's typically where we have a significant holding, and there's a question we have, there's perhaps an outlier practice we've detected. The reason I'm sort of citing all that is just sort of give you those data points. And by the way, the proactive engagement is, of the total we'll conduct in the course of a year, it's just shy of a quarter. So that's happening more often. For European investors, it's very common to be initiating the engagement. But I would tell you that for those firms that are coming to us, I'd say naturally about a third of the time there's now a director involved. And that raises the stakes in a very good way. I think you're going to get your investors to come to the phone and accept a meeting if you have a director there. You have the chair of the comp committee, the lead independent director, et cetera. It becomes very good. Now, clearly, there are all sorts of caveats that come along with it. I'm with Sarah. I think Sarah and others in this space deserve a lot of credit because the kinds of conversations we're having today in 2019 are far more advanced than they were even in 2016. High degree of preparation, high degree of understanding, and a focus. It's made those conversations much more fruitful. And by the way, I think it underpins a lot of some of the earlier points we've talked about. It's just there's a better understanding today.
And one other concept I wanted to add, and maybe you know this, but the flip side of the table, so the activist community, are also building relationships with us as investors. So, and they're doing it in a blue sky way, not talking about a specific company, but they just want to understand our philosophy. So they will, in a contentious situation, pick up the phone, and I have a multi-year relationship with them. Does that mean that they're getting undue influence? I hope not, but the lines of communication are open. And it's very important because you can imagine in a contentious situation where you're reaching out to the company, you want, we're not gonna have this deep relationship, but you at least want to know who the folks are, and so I can steer you to the exact right PM who's been analyzing your company. We're going to have a really solid conversation. It just helps if there's some level of connectivity. So I don't want to, it's not trying to spook you, but it's just, that's the reality of the market. And I'm an index player, but we just have a big position, and they know in a contentious situation, they want to know that they could we'll be open to hearing their position, and we will be open.
Just emphasizing 3 of the practice points that you just heard. One, there's a significant move towards the shareholders deciding whether to interact with you and not you just reaching out. There's certainly some very involved processes in that. The second is that if you just have a phone number to call, that's worth the first engagement. And then lastly, excuse me, John started with saying you should focus on, do you actually have anything new or different to say? And I have to say, I often start with a client saying, okay, you want to have an engagement, what the heck do you want to tell them? Do you do anything that's different than anybody else? Don't go in and say we have a majority of independent directors. It's a sleeping aid. But that was his opening point, so I want to emphasize that. So quickly before we move on, either of you, do you want to share any examples of what not to do in engagement meetings?
Sure. I've
No names,
you know,
just
well, yeah,
examples.
I won't do that. I had an experience I was reflecting on not long ago. The focus with a particular company was compensation. This was a firm that had failed, say, on pay. The firm was sort of standing on the precipice, looking over, about to begin what became their death spiral. In this case, the entire compensation committee was on the call, and it was four people, I believe. And as we debated various points of their compensation structure, which is what we focus on, not pay and performance relationship per se, a debate broke out, let's call it that, among the comp committee members.
That's a bad idea right there.
Yeah.
Don't do that.
Yeah, and it became a point of contention to where it revealed not only sort of differing areas of emphasis among them, but sheer disagreement on performance, sheer disagreement on the structure of comp. You know, it was bad. But one of the directors was really quite frank, and I have to say one of my favorite all-time lines came out of this, despite it being a train wreck for them. So one of the directors counted. This was a company that, on all comparable measures, was bottom relative to their peers. It was just obvious, and that was really kind of what sparked the debate. And one director, I suppose, trying to be sort of positive or optimistic, said, "Well, you know, look, on this one single metric, we're at top of the heap." Where this director, who was trying to be candid through this whole thing, said, "Well, this is the quote. Yeah, but that's sort of like saying Mo is the smartest of the Three Stooges." So, these were public company directors, folks. Yes. So I think the moral with that, Sarah, to your point, is and this is again better in 2019 than it was. I think this was 2016 or 17. Directors do need to be prepared. You know, many are public company executives, certainly are accomplished individuals, great thinkers. There does need to be some time spent with management. There needs to be clarity around focus, objectives, messaging. But the moral here is you have to understand what it is you want to convey to your investors, and you have to be clear about it. And you need to make sure the people who are ready to spend time with investors are ready to respond.
Yeah. And I don't know if it's a horrific story. It's more of a head scratcher. And I've told you about this one, Sarah. Similar to Mac, we do outreach for engagement, but those are much fewer, and we really spend quite a lot of effort thinking about our outreach engagement. So we really, focus them. We try to put an incredible amount of preparation, and it tends to be the old-fashioned, very thoughtful, one-page letter addressed to the CEO chairman, and it explains our philosophy of what we're asking about. And again, we don't do many of these. Think of it, if I were to imagine in the US, how many times we write these direct outreaches, probably, 90 or 100 companies. And we've done a focused outreach on culture. And culture, admittedly, to understand the culture of a company, admittedly is a very squishy topic. And we recently wrote to a company that we have a multi-billion-dollar position in, with very humble opening that we're doing exploratory research. We'd love to talk to an executive on your team or a board director that could give us some insight of how you approach this topic. And we get back about a 6-line sentence that says, "We're not interested in talking at this time." Let me caveat by saying that in the popular press, this company goes unnamed, but in the popular press, there are boycotts and people walking out of this company. And so we have a billion-dollar position, multi-billion-dollar position. You're not willing to speak with us in incredibly friendly terms. There will be waves of shareholder proposals, I promise you, this next season. And how do you think we're going to vote?
Yeah.
This company is not a client of ours, but I did actually personally speak to one of the directors and suggest they get back to you. Did they?
Not yet. Not yet.
Good. Lovely. All right, and I will just mention briefly, we discussed this at dinner, a what not to do. There was a recent meeting between a male CEO, 3 female directors, and a proxy voting team. And the proxy voter asked a question directly to the female directors, and one of them turned to the male CEO and said, "Is it okay if I answer that?" Yes, do not do that. All right, let's move quickly to third-party sources of information, which include 650 different ESG scorecards, but many, many other sources of information that asset managers use to make buy, sell, voting, and other decisions. There have been a lot of questions about that, so I haven't been forgetting you. That is this section. It seems to me that there's been a significant trend in the last decade as index funds, quants, ESG shops, and simply active managers need information that companies are not providing. They are turning to third parties to get that information, particularly because big data allows the collecting and analyzing of very interesting information that heretofore has not been touched. So there's been a rapid growth in the cottage industry of third-party providers of information, even ones where they're not clients of the big shareholders, but just, LinkedIn can give a feed to some of the things that don't appear that asset managers can look at, and so forth. So given that it's now the case as of this month that half of all North American proxy votes are cast by index funds or positively screened ESG funds, which means many companies' IR functions are reaching an increasingly smaller percentage of your shares, I thought it'd be useful to have each of you get a sense of what are your main sources of information, what are the critical must-haves. I'd love to know what you look at first thing every morning that's work-related. Which scorecards do you use, and to what extent are you shifting to in-house analysis that might previously have been coming from third parties?
Sure, I can start with that. So from a legal and general perspective, I mentioned earlier that we have an ESG profile on every public company in this room. And that profile is generated in the following way. So we subscribe to, I believe it's just over 20 different ESG data service providers, so all of them. And over the years, we've developed our personal preference of which so we take those headlines, they usually come in the form of a rating, which is very different than ESG data. So let me just make sure everyone's got that clear. ESG data is a specific data point that they've combed through your public sources or sometimes modeled and created a piece of data that's a hopefully factual piece of data about your company. And then they take these different pieces and roll it up into a score. That process creating a rating is totally different than an individual ESG data point. And that's an important difference. So we buy them all, and they almost always come packaged as both the rating and also the underlying data. And we use almost exclusively that underlying data. And we create our own ESG profile of what's important to us. And that really does vary depending on investment strategy. So if we are creating an index strategy that's trying to have ESG leaders that are all around disclosure, that's totally different than what I was mentioning earlier, which is our high-grade fundamental research team that's trying to find a material insight. So the sources of data are different, or the sources of data tend to be similar, but the exact use and how it gets packaged varies depending on the different sources. Let me just add one more from just ESG data, and what would be my advice for directors, and maybe it's hard for you directly, but make sure from a company, I would kind of break it into three things. One is know your ESG profile of your company today by a handful of the leading providers, MSCI, Sustainalytics, ISS, and Bloomberg. I'd say those four, at least you're going to have a sense. So first, know it. Then I would make sure your IR team is managing it, right? So first you know it, and then if there's any problems, risks, you're out there, improving it. And then the last piece, which is, I would say, more for the leaders, is have a point of view. Go own it. Know where your strengths are. Know where you want to take your company. We know we're leading on many of the environmental issues. We're going to stand ourselves out there as a leader, and then that may get you added to different indexes. But that kind of process, just starting with knowing, then managing, and then actually having a point of view and owning is how I would kind of think about your journey.
Mac. And then we're going to speed through compensation and what you need to think about in the energy sector all in 10 minutes.
Okay, I'll be brief. For issuers, sort of the old adage of cash is king. For us, data is king. And it gets back to our opening remarks. We need adequate disclosure from issuers. And of course, the challenge is what do we want? How do you go about doing that? as a plug for the Sustainability Accounting Standards Board, or SASB. That is an organization that is attempting to bring shape from a standpoint of what's financially material, and they've developed accounting standards for E, S, and G factors. We think that that's frankly where the market may be going to help sort of bring focus to what data you ultimately disclose. I think John gave you superb advice around understanding what the rating agencies in the ESG sense think of you. In fact, quick show of hands, Sarah, if we could. How many of you know what your MSCI score is at your firm? And some of you are on, it's okay. Some of you, of course, represent several firms. Okay, very small percentage. I would recommend you know what your score is, much like you might know what the sell side is saying about your stock.
And quick plug, it's free. So you can go right now to MSCI, put in your company, and if you have a company address, they will email it back to you, and it's pretty detailed. So it's like, it's a resource.
We too are reliant upon these third-party ratings firms. They're a necessary evil in the marketplace, if I can coin it that way. We happen to believe, and we've got the data that shows that rating, I just asked you if you knew what it was, has no correlation with your market performance. So as an active manager, we're effectively no longer thinking about what that rating is, but we are thinking very deeply about what the data and everything else that goes into that. John described that process. That's where they're performing a service for the marketplace, is aggregating the data that you're throwing off, whether it be quantitative or qualitative. It's being ingested by large managers like us. We too have developed a proprietary quantitative rating on 6,500 companies around the globe, and it's how we are approaching sort of the quality aspects of ESG performance of our holdings.
And since we don't have a lot of time, but we have a number of questions asking the same thing, the slowly accumulating ESG data is now enabling you to show links between companies that are better performing on ESG and enhanced long-term performance. That's a yes, no.
Yes.
Yes.
Excellent. Like questions like that. All right, speed dating to compensation. An awful lot of compensation packages look alike. People learn what works. 1/10 salary, 2/10 bonus, divided into 2 halves. 7/10 equity-based pay, sometimes 1, sometimes 2, sometimes 3. But it does seem like there's a little bit more creativity in the last couple of years going on with pay plans, and some increasing willingness of shareholders to ask some new questions. I will flag that just recently I've heard a few more questions about why there are no hold to retirement provisions in most equity plans, and why so few directors ever buy shares with their own money. And I'm wondering whether each of you have any other new things you are asking about pay. And if it's a no, that's okay, because we only have 11 minutes left and a couple more things to cover.
Are you measuring, are the metrics that underpin your long-term incentives measured relative to peers? Are they absolute? We're the bettors at the horse track window looking to put money on the winning horse. So we want to see performance relative to peers. We hope that the incentives, the metrics that underpin those, are similarly gauged.
Do you agree with the Australian regulators that half of all metrics in pay plans should be non-financial? That was a no. Okay.
There's not too much new. I'd say the one area that we keep having disagreements is how you value options, although options are on the, I'd say, the downcline. I'd say just this time horizon of how we think about it versus companies has been a constant source of conversations.
All right, let us move on to ESG in the energy sector. We discussed last night at dinner that the main, maybe not an ESG issue, maybe it's a G one, the main focus in the sector is that the percentage of the market assets that are invested has dropped from around 15% to around 4% in the last few years. So there's obviously not a lot of confidence. How do you look at whether you're willing to hold companies in the energy sector? Do you think that the 4% will continue to go down? If you were a company in the energy sector and you wanted to attract more capital, what would you do?
From an active, you start.
Yeah, my answer last night and to today still stands, which is, so I'm consistent, I guess, in that regard. As active managers, and it will vary whether we have a strategy that's, say, income-focused or value-focused or growth-focused. But we have the ability to not mirror the benchmarks. So that 4% in certain of our, I'm thinking of our value and income portfolios is not consistent. We will overweight sectors. Of course, with cyclicality of the energy space, that's something that has to be taken into account. But the 4% doesn't necessarily daunt us. I think with the path forward, with ESG and sustainability broadly coming into play and the influence from Europe and the fact that many of you have had, and maybe less so today, European investors, I do think that if I'm in this space and I want to continue to be attractive, to the extent that I can, I need to be telling my carbon-focused story as fully as I possibly can, with an emphasis on how we are thinking about the path forward. And I don't mean in terms of emissions per se. I'm talking about CapEx. It's innovation. It's research and development. The focus right now for the Europeans, and I think will be for some American managers, is going to be how are we thinking about transition? What's the risk? How are we allocating funds? What do we see as the opportunities? And I think that will help to begin to tell a story in a little different way. What we're finding is the firms that remain highly attractive are not only those that are clearly well managed and have solid assets, but those are the ones that are thinking about the future and are able to message what that future is, tell their story well.
And because we're primarily on the equity side going to be an index investor, we don't necessarily have particular views on one company over another. I would echo Mac's concept that the differentiator from a stewardship point of view, or from a, we're stuck together, is really around disclosure. So where we see poor disclosure, that's going to be where we express our discontent. And so I imagine many of you in this room are familiar with the TCFD, Task Force for Climate Change and Financial Disclosure. That's rapidly in Europe been adopted as the default disclosure mechanism or framework. Now there's lots of different models of how people fill that in, but what we see is the leaders are engaging with us in very detailed fashion about the level of granular detail they're providing, and I think that's going to be on a relative competitive basis. Investing some resources to really tell your story will pay dividends in terms of having our kind of stewardship support along a transition. I
think the message would be think long term, not just short term. So here's what we think about the next quarter. It's got to be much longer than that.
Does the 4% go down given how many asset managers are now blacklisting parts of the fossil fuel sector? And a certain number of index funds have ESG screens in order to be in the index?
My own view is I don't see it going down rapidly. It's hard to predict on long-term viability. I just think it's going to change. I mean, we need the energy industry for a long time. So I think what form it takes, we don't have a bias against, I think our only bias structurally is we have a point of view that climate risk creates a systemic risk. And so to the degree that business models are going to adapt and be part of a solution, we will be there along the way. So it's hard to predict on what size and how the industries change or where.
But not down fast. So another quick question. For a number of years, shareholders who reached out to particularly oil and gas, E&P, super majors, asked for climate risk or scenario planning reports, forecast out into the future beyond a date when anyone can reasonably forecast, and tell us what your oil and gas prices are and whether you will survive. Interesting exercise. There now seems to be an increase in asset managers instead, or in addition, asking companies to explain how the physical impacts of climate change will affect their business, which seems to be slightly more concrete and measurable. Tangible. Are either of you looking at the latter?
Yes.
Yes.
Excellent. That is a yes. And I want to echo both John and Mac talking about the importance of telling your story, given how often, I'm sure you hear, but I certainly hear that oil and gas is the next tobacco. So somehow that has to be offset. So last, this is a question from the audience that I will throw at both of you. The question was the impact on what millennials and others will have on your focus. There is data showing that in the next 20 years, an amount of money equal to the entire S&P 500 will be in ESG-focused funds. So kind of a potentially massive onslaught. Look out 10 years, even though I just said you can't possibly look out 10 years. And tell me how the forces that come from your clients will affect answers that you gave today in a minute and a half apiece.
Sure. I mentioned earlier that ESG is moved from ethics to investment performance. And this idea of how does millennials' viewpoint of investing change investing, that's actually moving back towards that ethics question. So 2 days ago, we announced a partnership where we can create exposure that eliminates companies that don't fit your ethical profile. So from that vantage point, I think that's part of the future, I think. So we mentioned last night that European investors are norm-based investors. They're really willing to say, this is a line in the sand. We're not interested in holding tobacco or controversial weapons or whatever it is. That's going to become a lot more common. It's going to be a lot easier. The structural benefits of having a full commingled fund that holds an index that holds every one of your companies, if people are not interested in holding oil and gas, it's going to get a lot easier in the future. So I think one of the millennial trends is that whatever people want will be able to be delivered to them. Whereas right now, when I think about ESG, it's an investment risk question. It doesn't matter your preferences if you're a millennial or not. It's just me managing risk. It's a different question when we offer people's preferences, personal preferences. So that's one big trend to keep an eye on.
Mac, see the clock there? Don't go over.
Yep, I won't.
Okay.
The firm I work for is owned by Ameriprise Financial, so a wealth advisory business. So we think about this topic quite regularly. And the figure that's being kicked around today is something along the lines of $30 trillion will be passed to the current millennial generation in the next 2 decades. And so if you think about how grandpa might shape his investments, and those investments, those dollars being passed to, say, his granddaughter, it will be entirely different. How it comes to bear here, I think, still has yet to fully play out. It's a very nuanced space. I think a lot of customization. You can see a number of e-platforms where people can build their own sustainable portfolios. We have yet to really tap into what that might look like. I'm saying we, in the broadest sense. The other influence, though, that we can't overlook with millennials, and it's separate from millennials, is half of the money that our firm runs is brought to us by large public pensions. So, the Ohio teachers, or we run a lot of corporate pensions. But the public pensions themselves have begun to assert themselves quite significantly in this space. They're bringing us, hundreds of millions of dollars to manage for them in specific mandates, and it comes with thou shalt. You need to do this and that.
Like college endowments.
And we will manage to their requirements, and sometimes that will include some screens that will screen out. What we're trying to do, though, is trying to get them to think, look, let's look across the entire risk spectrum. Let's not exclude, but let's focus on the ESG risk characteristics and see where the opportunity really lies. But pressures are coming across all fronts.
Thank you so much.